The 2010 Tax Relief Act includes implications for everyone, including seniors. Items specifically affecting seniors include estate and gift taxes and IRA qualified charitable contributions. Here to explain more about how the tax law changes impact seniors is Larry Hicks, a partner at O'Sullivan Creel. Larry, thanks for being here.
Jeff, it's my pleasure.
Well, this was all, as we were talking earlier, passed very late in the year, and please mention about the forms. But it does affect everybody. But let's kind of concentrate on the senior stuff. But let's go ahead. What about the forms?
Well, you know, everybody who's expecting a refund is always anxious to file their tax return as soon as they can to get their refund. This year, they're going to have to wait a little bit. Congress didn't pass this law till mid-December, and they changed a lot. So things the IRS expected to be in the law for 2010, all of a sudden at the last minute, they're different. So they got to reprint a bunch of forms. So it'll be, instead of mid to late January when folks can begin filing, it'll be mid to late February, just as a result of the tardiness of Congress changing the law.
Okay, well, I'm glad we got that out there. Well, let's just start with, you know, many people are choosing to work longer. They feel good, they want to earn a little bit more money, and so they're staying in the workforce. So what about the Social Security tax reduction?
This bill has several components to it and several objectives, maybe I should say, but the central theme of it is economic stimulation. So they're looking to put money back in taxpayers' pockets with the hopes that we'll spend it and stimulate the economy. And one of the ways they did that is to reduce the Social Security tax deduction. That's a part of everybody's paycheck. You know, everybody knows very well that if you make $100, your check doesn't have $100 in it. Well, one of those deductions is the Social Security taxes. They normally are 6.2% of your gross pay. For 2011, going forward for the next 2 years, for 1 year, for 2011, it drops to 4.2%. So it's a 2% pay raise, essentially, off of your gross pay.
Does this affect the amount that people have paid into Social Security if they're thinking about retirement?
It does not. It does not. And most folks may not know, but the employer matches that deduction from the employee. The employer didn't get a break. The employer is still at 6.2%, but the employee got a 2% break. Again, just to put money in people's pocket. And that people will see that on their very first paycheck in 2011.
Well, that's great. We all like a raise.
Everybody likes a raise, exactly.
Well, let's talk about the IRA qualified charitable contributions. First, what does that mean?
A lot of seniors have IRAs, and as most of them will know, when you become 70 and a half, you're required, whether you need it or not, you're required to take money out of your IRA, and that requirement is there because the government wants to tax it, so they force you to do that. Well, this provision allows folks who don't itemize deductions, and again, that's a lot of seniors. They take the standard deduction, they don't itemize. Well, if you don't itemize, a charitable contribution doesn't reduce your taxes. You're taking an itemized deduction, so it doesn't impact you. This allows you to take money out of your IRA and to give it directly to a charity. But when you take it out of the IRA, it's not taxable. So it's a win-win. It's an incentive for people to be charitably inclined, but I can take $1,000 out of my IRA, give it directly to my favorite charity, and it's not income to me. It doesn't show up on my tax return. So I don't have to pay taxes on that $1,000, even though I'm not itemizing deductions. Okay. So that's the advantage, and it's in the law for the next 2 years.
Does that IRA account have to be set up specifically for that, or can you do that from any existing IRA?
From any IRA. Really, the only other requirement is that the taxpayer has to be at least age 70 and a half. So this is only for folks who are in that mode of having the required distributions out of their IRAs.
Great. Well, there's several changes related to the estate tax. Let's start with the exemption and the rate, for example.
These estate tax changes are really significant, and they're really good. We in the planning community, had this law not passed, we would be in a rough spot, and that rough spot was the exemption from estate tax. And estate tax is really a transfer tax. It's a tax on the transfer of assets when a person dies, the assets that they leave to their family or their beneficiaries. The government taxes that transfer of value. The exemption for that would have been $1 million. And you think, well, $1 million. Well, $1 million, that counts everything a person owns, their home, life insurance, cars, stamp collections, every asset a person owns. So $1 million isn't as much as you think. Most people could get over $1 million. And the tax rate was 45%. That's gone. What we have in place of it is a $5 million exemption. Pretty significant.
Big jump.
Yeah, and a 35% tax rate. So it's a huge improvement. The only downside is it's only good for 2 years. So we don't know what's going to come, 2 years out. But at least we have this for 2 years.
Okay, well, that's great news. Well, we talked about contributions and then inheriting, but what about the gift tax?
The gift
tax. How does that work differently or in tandem? How does that work?
Yeah, and that's a significant area, Jeff, because it changed. Prior to this law, the gift tax was $1 million. The gift tax exemption was $1 million. And what that meant was, if I'm a granddad, and getting on up in years, and so I want to benefit, I maybe want to help with college educations for my grandchildren, or I want to give away some things during my lifetime to see the benefit of that rather than through my estate. Well, I could do that up to $1 million, but beyond that, I'm paying a tax, a pretty sporty tax for that privilege. What this law does is that same $5 million that I get for an estate exemption is available during my lifetime as a gift exemption. Okay. So yeah, so it allows, this would be obviously for a little more wealthier people, but applies to anyone, so I can give money away to my family now rather than at my death and not have to pay a tax.
Well, I understand that for the first time people can actually leave the unused exemption to a surviving spouse. How does that work?
That's another huge benefit of this law. It's called the Portability Rule. And in a married couple, that $5 million exemption is per person. So for a couple, $10 million. Under the old rules, if I didn't use my exemption, if I just left everything to my spouse, for example, at my death, my exemption went unused and was gone. It was wasted. To avoid that, I had to do a bunch of complex planning using what are called credit shelter trust. That's all old school. What this law says is that for a married couple, if I don't use my exemption, it goes to my wife. So basically, the second spouse to die, at the death of the surviving spouse, that full $10 million exemption is available. And so it reduces the need for complex planning for a lot of people.
Okay, so what kind of conversations should they have with someone, for example, to make sure, or where can our viewers get more information?
Ultimately, the IRS, I'll give you government a little credit. Their website is well designed, has a lot of information on it, but there's nothing there about this law now. It's too new. So give them 6 or 8 months and they'll probably have some good information. Meantime, your folks are free to call us. We'll be happy to share information with them. Or you could probably just Google Tax Relief Act 2010 and find a lot of sites that will give you more information about this law.
I did that, and thanks for the suggestion, and I found a lot of information. So there's a lot in here, and sorry we've just got a brief segment, but I think we've hit the high spots. And Larry, thank you for being here, and thank you. I know this is a crazy time for y'all and you and O'Sullivan Creel, so thanks for being here and sharing with our viewers.
Jeff, thank you for the opportunity.
Well, we appreciate it.